All right, listen up. It's John OG. And if you're watching this on Monday night, March 2nd, you need to breathe. Slow down. Step back from the screen. Because what happened to silver today was not the death of the safe haven thesis. It was not the collapse of the metals market. It was not proof that everything you believed was a lie. What you witnessed was a trap. And not just any trap. A precision-engineered, algorithm-driven, liquidity-harvesting bear trap executed with surgical timing while the entire world was distracted by geopolitical chaos. As I'm recording this, my inbox is overflowing. Retail traders panicking. John, silver is broken. John, I thought this was the hedge. John, how does silver crash during a war? Let me be absolutely clear before we go any further. This is not financial advice. I'm not your advisor. I'm not telling you to buy, sell, or hold anything. I analyze market structure and institutional behavior. You are responsible for your own decisions. Now that that's out of the way, let's talk reality. Silver closed Friday at 93.18. The weekend explodes with geopolitical escalation, oil surging, equities bleeding, fear everywhere. By every textbook definition of safe haven, silver should have gapped higher. 98, maybe 100. We flushed to 87.92 in minutes. $6 gone, retail stunned, stop losses detonated, social media screaming. And then, almost immediately, the recovery begins. That is not organic selling. That is not profit taking. That is liquidity harvesting. Here's how the game works. Retail traders pile in over the weekend expecting a breakout. They set protective stops below 90, maybe 89.50, maybe 88. Clusters form, massive clusters. Institutions can see that liquidity, not your name, but the orders, the structure, the density. So what happens? A coordinated dump of paper contracts hits the futures market. Heavy size, fast execution. Designed not to exit a position, but to push price through known liquidity zones. Once 90 breaks, the cascade begins. Stop losses convert to market sells. Market sells push price lower. Lower price triggers more stops. Panic accelerates the drop. In minutes, the flush completes. And then the selling dries up. Because the objective wasn't to start a downtrend. The objective was to acquire inventory. Volume spikes during the drop, then collapses. Price stabilizes. Buyers step in, quietly, efficiently, professionally. By the close, we've reclaimed most of the move. That's not a market collapse. That's a stop run. Now, why would institutions go through the effort? Ask yourself this. If they believed silver was heading back to 70, why accumulate aggressively at 88? They wouldn't. Bear traps happen before expansions, not before collapses. Let's zoom out. We are in a documented structural supply deficit in silver. Industrial demand, solar, EV, electronics, continues climbing. Mine supply isn't matching pace. Above-ground inventories have been drawing down for years. At the same time, geopolitical risk is not decreasing. It's escalating. Energy markets are volatile. Sovereign debt levels are unsustainable. Global monetary stability is fragile. And on top of that, banking regulations increasingly recognize physical hard assets as balance sheet strength. So when you see a 6-minute waterfall during peak fear conditions, you have to ask, is this information or is this positioning? Here's another uncomfortable truth. Markets are not built to protect retail emotion. They are built to extract liquidity, and retail stop-loss clusters are liquidity. This isn't a conspiracy theory. It's market microstructure. High-frequency systems are programmed to identify inefficiencies and exploit order density. When liquidity pools form beneath obvious technical levels, those levels become targets. Today's 87.92 print wasn't random. It was precise. Now let's talk psychology. Humans are wired to avoid loss more strongly than to pursue gain. A $6 drop hurts more than a $6 rally feels good. That emotional asymmetry is weaponized. Sharp move, sudden break, fear spike. You hit sell. Institutions buy. That's the cycle. If you sold today in panic, you're not stupid. You're human. But understand what happened so it doesn't repeat. If you held, ask yourself why. Was it conviction, discipline, or stubbornness? Know the difference. Because this likely won't be the last volatility event near a psychological level. If silver approaches 100, expect turbulence. Expect another liquidity sweep. Expect emotional tests. Markets test conviction before they reward it. Now let's address the paper versus physical debate. Futures markets trade contracts. Contracts settle in cash, the overwhelming majority of the time. Physical delivery is a small fraction of total volume. That creates leverage in the system. Price can move aggressively without equivalent physical movement. That doesn't make the market fake. It makes it financialized. But during stress periods, financialized markets can overshoot in both directions. That's where opportunity and danger coexist. Premiums in physical markets often expand during volatility because dealers price replacement risk, not just spot. That's normal under stress conditions. The key takeaway? Short-term price does not always reflect long-term structure. Today was about positioning. Now what happens next? If this was a liquidity event and not a trend reversal, we should see stabilization above reclaimed levels. We should see options flow adjust. We should see continued monitoring of inventory trends and open interest shifts. But none of that guarantees price will only go up. Markets are probabilistic, not prophetic. What I will say is this. A violent flush that fully recovers during peak geopolitical tension is not a bearish signal by default. It's a stress test, and silver just passed it. We are living in a macro environment defined by high debt, fiscal imbalance, monetary experimentation, and geopolitical fragmentation. In that environment, hard assets will remain part of serious capital allocation discussions. Whether price moves cleanly or violently, do not let a 6-minute candle rewrite your entire thesis. Do not let headlines dictate your time horizon. And do not confuse engineered volatility with structural collapse. If you are trading short-term, manage risk appropriately. If you are investing long-term, understand your framework. If you're speculating, admit that to yourself. But above all, detach emotion from execution. The market will try to shake you out before it moves. That's not evil, that's structure. So tonight, breathe, zoom out, review your strategy, and ask yourself one question. Did you react or did you understand? This is John OG. Stay sharp.